Good morning, everyone. Tuesday, May 27th. Welcome to another Bitcoin Intelligence Show. Today, we have a very, very big announcement. We have Renaud Adorno joining the Bitcoin Intelligence team and 21st Capital. And he is an expert on monetary mechanics, everything about money flows in the world, which are extremely important for Bitcoin. Anyone who wants to understand Bitcoin has to have an eye on anything money. And we have the expert in house. Welcome, Renaud. How are you?
Doing great, Sina. It's a pleasure to be here, to be working with you. I've been following your work for a long time, so really excited to be here and contribute a little bit on the monetary mechanics.
Thank you very much. Yeah, Renaud is a celebrity apparently in his own language, so we are lucky to convince him to join us and produce content in English, which is going to be very, very exciting for our audience. So so here's the plan today, right? Let's introduce you and review your background a little bit, and also the second half we will look at your outlook for 2025 and what Bitcoin investors should expect from the market. All right, I'll start it off. What's your background and what's your expertise before joining Bitcoin?
Got it. Yeah, for sure. So, it's not the usual path that we could expect. So, I'm more of an entrepreneur myself, as a business owner for over 10 years, and exports and imports of building materials, basically hardwood flooring. How I got here, right? So basically, it was all about the flow of money and payment. So it would deal with a lot of international payments and a lot of hurdles. And I couldn't understand why smaller companies could get funding and why other companies would get it much easier than us. And this led me to the rabbit hole of macro, about money, then debasement, and that's how I got to understand a little bit more of Bitcoin in 2017. So I got that bull market for on the 20,000, and then I really learned the hard way on the bear market afterwards of 2018. But I didn't really know what to do with it. But I became a FINRA, a licensed firm professional in the United States 2 years ago. My last employer was Empower, dealing mostly with 401ks, IRAs. Very grateful, but also very limiting as well. Couldn't talk about Bitcoin, couldn't assist people with their 401ks over there, except to roll over to to a competitor. So it wasn't ideal. And this is a great opportunity to understand macroeconomics, which is really something that I'm passionate about. I do it every single day. I have my own YouTube channel, but mostly for Brazil. So I teach the plumbing part, so to speak, that drives everything in markets and liquidity. And this is what I spend most of my time with. And
a Bitcoiner that can't talk about Bitcoin, right? So, so yeah, I mean, you have this unique background. You understand Bitcoin. You understand business through years of experience. And it's a very hard supply chain, hard materials supply chain business. It involves imports, exports, production, sourcing, marketing. So pretty exciting. And then you added that deep knowledge of finance and advising, and you were deep into the rabbit hole in the financial world. You've observed all the issues of the limits, of how like traditional institutions think about money and Bitcoin and investments and all that. And you've also been discussing with the users, or what should I say, like the potential users that might be interested in Bitcoin. So people's issues, concerns, worries when it comes to investment, and what are the major pitfalls and all that. And you've also been creating content, right? So tell us more about your YouTube channel.
Yeah, so it's basically my name, first and last name, which is in Brazilian Portuguese as of now. So now it's a pleasure to do it in English through 21st Capital. But I talk mostly about all the narratives and macro that drive our markets and the confusion, interest rates, the Fed, central banks around the world, how that drives liquidity. Is the dollar dead? Do we have a BRICS currency coming up? Is Bitcoin going to replace everything? Is gold going to be this? So I try to get that tension and getting many points of view so that people can make the decision on their own. But of course, I absolutely love Bitcoin, and I believe it's going to be a revolution. Sometimes not the way that most people think about it. So it's a changing landscape, and just following and documenting every day is basically my passion. And got to put it to work to help people worldwide.
Fantastic. Yeah. I mean, we do a lot of analysis on using Bitcoin price models, on-chain data, and macroeconomics, and adding a deep expertise about monetary flows is definitely going to make our package complete. So, yeah. So let's move on to the second part of the discussion is, which is, we want to learn a little bit about your perspective and outlook in 2025. So when you analyze the market, the metrics, the data points you look at, with interest rates, with the plumbing of the financial system, all the things that are worrying right now. What's happening in China, the potential deflation, what's happening with Japan's carry trade, who's dumping the U.S. bonds, why the yields are going up all around the world. Should we be worried about these? What's the likely outcomes later this year? And overall, when you look at all this package together, what do you see coming for the rest of the year? And what makes you excited? What makes you worried?
Yeah, I mean, it's a lot of stuff. We could talk all day about that. But what I try to do is a framework and separation between the United States and the rest of the world, because I think the most of the confusion is treating the U.S. in isolation, and everybody just focuses on the United States with the $36 trillion debt, and this is going to explode, and because of that, the whole system is going to collapse. And because everybody is worried, they get carried away with the motions, and that automatically means that something imminent, right? Which drives a lot of behavior for investing. So I try to get a little bit beyond the narratives and the smoke screen, so to speak, and understand that everybody will continue to need dollars and the liquidity that bonds provide, that they have a bigger role than just the debt of the United States, but try to get a notion that this belongs to the whole world. So even if we analyze the US yield curve, it doesn't necessarily talk about only the United States economy and what we expect. Are we going to a recession? Are we on a Goldilocks situation? We heard everything, right? Soft landing, hard landing. So this creates a lot of confusion. So I try to separate things in understanding why this is so important for liquidity. And when we get deeper into it, we see a huge difference between financial markets and the real economy. These are unfortunately very unrelated, right? And maybe this will change based on what we see on the current transition to the Trump administration. We don't know it yet. A lot of unknowns. So volatility for sure is something that I see for the rest of 2025, but not necessarily in a bad way. This will be part of the whole situation. Of course, tariffs is part of that, but mostly how the rest of the world is seeing the current results. So just for example, today we see a S&P 500 going crazy now, 1.63% as we speak. So a great opening just because of the whole Europe situation. So I see a lot of maybe just headline trading, headline movements, and I try to get past that and see of the outlook towards the end of the year. So I see some liquidity hiccups, especially based on refinancing of debt, corporate and public, that we're going to see in 2025, but nothing that would really break the whole system to create a deflationary spiral in the United States. So liquidity is still up, money markets are still flowing. Collateral, it's something that is a theme of mine, is has some hiccups because of the whole volatility on bonds, which is undesirable if you need more credit, but nothing that has broken up, and a lot of cash is flowing into bonds, especially on the short end of the curve. So, and this is good for Bitcoin. So that's why we see Bitcoin soaring. We see gold soaring. We may see maybe an S&P 500, some money coming back after that pause of the U.S. exceptionalism. So it's a lot about narratives, but we need to see the mechanics as well.
Yeah, fantastic. So, what do you think of all the so recently discussion around M2 money supply is very popular. A lot of people are excited about the M2 chart going up. What are your thoughts on M2 specifically, and then more broadly the trajectory of liquidity this year?
Yeah, this is a great question. So I'm not specifically a critic dismissing M2 completely. I see the point. It makes some sense, like a broad sense about liquidity. Global M2 is kind of one of the best used, despite it being imperfect. I would just be careful about the content of the composition of M2. So M2 going up doesn't necessarily mean this is going to be a ready, available cash that is going to be immediately deployed into the markets, because a lot of that can be created by money market funds. And it's all about some money that could be trapped for some time to be deployed later. So we have a lag. Most people are going to say, yeah, there is a lag, maybe 12 weeks, maybe 20 weeks, maybe 10 weeks or whatever, that is going to translate into Bitcoin price. Of course, it's a higher probability. It helps, but it's not the be all and all. So, and onto M2. So I'm careful. I try to see other metrics as well, especially on the bond market, on Sulfur, on what's happening, because that is the factory. So I try to look for the factory instead of the products being released, so to speak. If we can use some analogies, that would be I try to go for the source. So that's
Money
basically
factory. Yes,
exactly
Great
how
way
it's
to think about it.
printed. Yeah, exactly. But I also see a lot of what's happening in the US and China as well. So these are big factories, so to speak, that are driving a lot of the market conditions. And that dynamic is something that I would look closely onto define what's happening.
All right, so let's be more specific. M2 is a little bit complex and nuanced. What do you look at that gives you a better signal for liquidity?
Yes, that's a great question. So I look specifically on yields on the short end of the curve in the United States. I look at Sulfur. So for example, Sulfur is what we call the secured rate, overnight rate, that where counterparties use bonds as collateral. That's basically, if we want to understand liquidity, we need to understand the repo, right? So we use bonds in a very short sell and repurchase kind of agreement that works as credit. It is not, but it works as if it was credit. So this drives.
Let's make sure we also explain repo for some of the audience that might not be familiar with it. What is repo? Why does it matter?
Yeah. So if before 2008, if I want to get some money to borrow some money from Sina, I would say, hey, Sina, we know each other for many years. Can you lend me some money? Yeah, of course. I know you. It's perfectly fine. It's based on reputation. But after 2008, things changed a lot. So it doesn't really matter. Look, Renaud, I know you for some time, but the market is a little crazy. So give me some kind of collateral, something that, let's say, your car or something that I could sell just in case you're not able to pay your obligations, right? And you're able to liquidate that. And based on 2008, everybody agreed that they had to go for the safest and most liquid collateral, and that became US bonds. So this is basically 80% of the worldwide credit is based on collateral, especially US bonds. There are others as well, mortgage-backed securities, but we don't want to overcomplicate it. So that kind of interest rate based on a safe transaction, at least to be considered safe by the market, which is repo, can give us an idea if this is going well and not, or not really, or if collateral is available, right? And also we can look other things like the RRP, which is reverse repo, that is done by the Fed, where banks can uh, lend some extra cash to the Fed, and also the current cash conditions of the Treasury itself, because the U.S. spends a lot of money, so it's a lot about deficits and public spending. It is unfortunately what has been driving the markets, not really the free market, but government spending. So I try to track those on the US side to see how that drives liquidity of Bitcoin, and that has been for sure been a tailwind that has helped a lot of the price action.
Yeah, that's a great point. There's also government deficit, right?
Yeah.
And with all the discussion around reducing the deficit, and we are worried about next generations, and we want more fiscal conservatism and all that. I think it was pretty clear from the outset that we won't see any meaningful deficit reduction. Not because it's not desirable, but it's pretty much impossible, both mechanically, because if you do that, then you're going to break a lot of the world's collateral system, collateral base. And so for renewing your borrowed money and your credit, you need a constant supply of treasuries to the world. So you can't stop or pay back your debt too much without breaking the world. One thing. Second, politically, no one agrees to cutting the spending and government borrowing, because you would be very unpopular. Everyone is there to take more of the public pool of money. It's for everybody. It's somebody else's money, so they would just spend it like there's no tomorrow. They would all add little bits and pieces to spend more and find different reasons to spend. At the margins, there would be people who say, hey, you're worried about it, but when it comes to actual cutting, anything you want to cut, you're going to make somebody angry, and you won't get the support and political backing to do it. So cutting is hard, adding is very easy, because everyone wants more support, and then you can just go online and say, oh, this is what I'm doing, you elected me, I'm giving you more support here and there. And if you actually look at a lot of politician resumes, the way they talk about themselves is, I brought funding for farmers, I allocated this much money to this and that. So all politicians basically are proud of is they added more expense items that helps this group and that group and this group and that group, and it's all about that, right? No one talks about more making things more efficient. No one talks about cutting spending. So politically impossible, mechanically impossible, and but they made a lot of noise about it, right? And we don't see deficit going down, and interestingly, it's actually going to go up. What do you see on that front when it comes to tax cuts or any other budget changes?
Yeah, many cross currents over there, because we had a lot of hype for Doge, and then we see Elon Musk just going, "Hey, what did you do last week?" Right? And oh my God, this is going to cut a lot. And all of a sudden, he's seeing that there is a huge difference between the government spending and family spending. Budgeting is completely different on a government level, and even worse, since your bond curve doesn't belong to the United States, and interest rates are the biggest expense, even going higher than the military itself, that creates a lot of problems. So the government does not have full control on its own debt. So because it depends on others who need that as collateral, which is mind blowing to be honest when I first found out. So this, I don't see it going down anytime soon, especially on a regime where we have expectations, we may be wrong or right, but about inflation. And the bond market is punishing a lot of that expectations, requesting a premium, and that increases spending. So even if you get rid of fraud, you get rid of a lot of the things that are actually, it's noble. It's completely, it's not political at all. So it can be very noble trying to reduce that, or at least change the direction. But structurally, it is needed. And this is a paradox. So we see a lot of the euro-dollar system, as we call it, the dollars outside of the United States. So nothing to do with Europe, just means outside when we say Europe, for those who don't know. They need collateral, and we don't have enough. So even if we provide more, if the United States provides more, it just gets absorbed, because as of now, we have something called rehypothecation of collateral because we don't have enough. So we use the same collateral in two different places at the same time, which we shouldn't. So that shows how hungry the whole world is for debt. So imagine you're trying to get rid of that. Oh, let's reduce it to 30 trillion or to 20, or pay it off. If you pay it off, you just break the whole system, because it's a debt-based system. So you need to pay your principal plus interest, making it mathematically, demand is always higher than the supply. So what would be the number? 40 trillion? 100 trillion? It doesn't really matter if you understand the mechanics, which is a completely paradox. That's the problem with the fiat system.
Sounds like a Ponzi.
Smells like one, sounds like one. And he goes on, which is completely mind-blowing. It's sad, but true. Gotta learn with what we have.
Yeah, it's this dual role that complicates everything. Government debt is not as easy as government borrowing from someone else. Government debt functions doubly as creating the money, like being the money factory for the world, right? And these two cannot be like analyzed independently. If you want to reduce government debt, there's lots of ramification for how well the financial system works. If finance breaks, everything else breaks, right? So as a former manufacturer, you know that you can do all the great things on your operations, but without finance, none of it really works. So when you have a breakdown in monetary system, then you immediately get rapid breakdown in the actual real economy. So that was actually part of the reason we were very confident earlier in the year that none of those cuts will happen. And but if the cuts were to actually happen, we would have predicted a horrible situation, perhaps a recession. But when you solve the game theory, you realize that the optimal course of action is to say that you want to reduce the deficit, and you may actually really want it. Like you said, it's a noble goal, but going out and actually doing it will quickly teach you that, hey, you can't. So the best they can do is to not expand it, or not expand it rapidly. For example, after COVID, we expanded the debt, I think, too much. They bought anything and everything. And they, for example, didn't need to really pump the housing market to this extent, which they did. And then now we are dealing with 5 years later, we're dealing with sticky inflation that's not going anywhere. So maybe you can be more responsible here and there, but the expansion is a fact of today's life. And if money is expanding all the time, just imagine what happens to an asset that is inelastic in its supply, right? So that's why Bitcoin will keep always going up, because the fiat has to expand and inflate not just because politicians are bad people. It's just that's the design of the system. It has to happen, and Bitcoin has to go up. That going up sometimes takes a pause, takes a catches its breath, but it will catch up quickly after that because that's the mechanics of the system.
Yes, not to mention that we have a huge demographic problem where we're not able to guarantee that productivity. Of course, we have AI coming up. It's a whole debate on how productive we're going to be after that. That we're not going to need people, but the way that we're currently going. Deficits are just going to be a natural path, unfortunately, to compensate for the lack of productivity, especially everywhere else in the world. So this is always a relative game, right? So we have to see the conditions of countries who are not able to print their own dollars to participate into the global economy with exports and everything. That's the U.S. exceptionalism, so to speak, even though we have the same problems in the United States, but with the money printer on the spending, which everybody else doesn't have. So either we have activity going on that allows countries to be able to get those reserves, of forex reserves or dollar reserves, so to speak, to be able to control their own currencies, which also controls a little bit of inflation. But every country has a different situation, but everybody is losing productivity worldwide. So birth rates are just dropping. And so this is a theme that happens in the United States. Everybody's worried about the 36 trillion. I totally agree. But worldwide, it's not much different. It's even worse. And that is the problem. So it collapses from the outside, and eventually it comes home. So this is where asset holders shine, especially on completely inelastic assets like Bitcoin, for example.
Yeah, talk about growing your way out of the debt. And this gets really terrible when you look at China itself, because they have just made it mathematically impossible to catch up. Their demographics are such that they won't have enough people to keep producing and keep being productive. And this is something you absolutely cannot fix unless, I mean, you can't manufacture humans, right? So you can actually be confident that in 10 or 20 years later, what would the demographic structure look like? Just because it is set in stone. Once you are not having enough kids, it's obvious what's going to happen 10, 20 years later. And immigration probably can't really make a dent here. And once you don't have enough productive people, then you can't pay all the obligations to the older generation. And the only solution is deficit and monetary expansion. And this is not a good outcome. Like on net, it's bad. It's horrible for you. I mean, if you expand money and if you're not expanding productive capacity of the economy, nobody gets wealthier. You're not creating more wealth. You're just redistributing it. But the best people can do is at least position themselves in the right assets and in the right allocations to protect themselves against the negative consequences of all this. Now, perhaps as a last idea, we know that tax cuts are making great progress in the Congress, I think, and all the signs I see is that it will just keep adding to the deficit. But the other part of the three-legged stool, as Scott Bessent says, is the deregulation, right? What would you say? Because deregulation is a very vague concept, right? It could mean nothing, or it could mean a massive unleashing of business spirits, right? What do you see there that's important and is likely to, make a dent in how this year unfolds? Or maybe look at it the other way. What's the main regulation that is, acting as a bottleneck on the global economy?
Yeah, that's a great question. So basically, banks since 2008, they got a lot of regulations that end up being a framework of Basel III. But I try to make it as simple as possible so that we don't overcomplicate things. So basically, we created a system where there were different kinds of handcuffs onto banks because the whole idea would be for us not to have the next Lehman Brothers and Bear Stearns. So if somebody asks me, are we going to have a crisis like the 2008? My answer is definitely no, because there's no way you can reproduce that with the current regulation that we have. But we went to the opposite spectrum. So we went way too harsh on rules that not only did not eliminate the risk, they just transferred it to maybe offshores and other shadow banking. We can get into the details about that later. But we basically have two big limitations, restraints to bank lending, which are not helping economies grow worldwide, because it's Basel III, it's a worldwide system. We call them SLR and RWA. So basically the idea is banks should not risk themselves too much into too much of a risky investments like stocks or derivatives. So RWA takes care of that. SLR, on the other hand, tries to go for the leverage. So even if banks use bonds, which is considered to be as safe as possible, they can over leverage themselves and create risks into the market. So SLR takes care of that. This is mainly what Besson is talking about, to try to get rid of those, because the main concern is, if we have higher interest rates, that means that bond prices go down and we need buyers. And SLR is preventing many of these banks to buy bonds when they are actually needed for the plumbing to work. So it's not because we don't trust the US debt, it's because we don't have any space on my balance sheet to actually do it, which is a pretty good idea. It's something that happened in 2020 during the pandemic, and it was a temporary kind of thing. They're thinking of bringing it back, and Besson is actually confident they can get it passed until July to get it done. However, it doesn't solve all problems. So right now, RWA, which is not being discussed, is not really on the table. Maybe it is, or we don't know, but not publicly. And it depends a lot of political will and a lot of conflicts, many ideas floating, because it's not something that depends exclusively on him. So it's pretty open right now on what could happen. So whatever path is chosen can be an extremely good outcome, but otherwise it can just be a narrative that doesn't fix the plumbing, but at least psychologically the market can act on it. But at the end, the laws of physics prevail. So maybe they will do it the right way right now, but maybe only through pain afterwards. But change is definitely needed.
Yeah, fantastic. So I think we covered a lot of ground today, and it seems like what I get from everything you say is we're going to have definitely improvements on the margins, more fundamental things like getting rid of some of the limiting regulations, but there's a lot more work to do there. As far as the fiscal situation, it's definitely going to get worse on the accounting side, but better when you look at the hard assets. So there's support. I myself am very bullish second half of the year, and I do expect a little bit of volatility still in the next month or so, just because we haven't seen the total effect of tariffs yet. But the thing is, the longer it takes, the less of a shock it will be that eventual damage that these minimum residual tariffs will do to the economy, and the markets will have priced it in already. So even if it's something we haven't seen, if it unfolds over time slowly, it will not have any power to derail the markets that much. And as we get closer to the end of the year, more of the positive effects related to monetary expansion and tax cuts will start to emerge. So we had this really interesting fight between two forces that come from Trump policies: reduce the deficit, bring back manufacturing, reduce the trade deficit, fiscal deficit, and decouple to some extent from the world, control China, all that negative for the markets. That all happened at once in the beginning. and it's now losing its power, and a lot of it is just not practical, and market is getting a hang of it. We still have some of the rhetoric, but the real stuff, the real positive stuff, still are in the making and far from being priced in. So I think we are going to have a really, really good year moving forward, and we also look forward to learning more from what you see and what's happening in the on the money side. Again, one of the most important things for Bitcoin is money. Like even more relevant than Fed rates cuts or labor situation is the exact things that are happening in the financial world and in the money. Because the moment there is a hiccup, people sell risk assets to raise some cash, and they do sell the bonds and everything, but also risk asset will be among the first things that sell off. That's why you get some volatility in Bitcoin. So we look forward to tracking the flows of money, global capital movements with you. And I think we got a really great look into how you view the world. Any final ideas, any final point before we wrap it up?
I mean, I think it's going to be a great addition to the actual report by when we introduce the monetary mechanics part into the reports. I'm very excited to be able to contribute on that matter. So for our premium subscribers, but for sure, I would really think if just by changing how we think about the U.S. debt not being the same as everybody else's as collateral, it makes a lot of sense to track liquidity and see things from a 30,000 foot view. But there's a lot. I would also watch for the debt ceiling negotiation. So the government should run out of money, quote unquote, by August. So we're gonna have this whole theater. It's part of the game. We need to keep the game alive. But that should suck a little bit of liquidity as well. But it would be a hiccup. I don't see anything just stopping things. So I wouldn't be too worried about drawdowns, volatility. It would be part of the game to be expected. But what really matters is the overall liquidity, the resulting force afterwards. So
it's actually a good thing because it creates a deadline for policymakers to move the tax bill along. So it's actually a good force for them to get things done. Yeah, fantastic. Thanks a lot. I think this was one of the most dense and detailed sessions we've had. Thanks a lot. We touched a lot upon a lot of topics. Looking forward to go deeper in future. Renaud, thanks a lot for joining, and thanks a lot for the wealth of knowledge you bring to the show. If people are interested in following our main content, you can join Bitcoin Intelligence Platform at 21stcapital.com/BI. You will find access to our written reports, weekly newsletter about markets and Bitcoin and on-chain and monetary mechanics. So plus you will also get access to all our videos and models and charts. So definitely check that out. And we will see you again here on this channel and keep discussing Bitcoin and analyzing the market. Thanks a lot, everybody, for joining us. Thank you, Renaud. Bye-bye.
Thank you. Take care.